Every quarter, we get to see the companies that Nvidia are investing in, and one of their most recent purchases was Nebius Group, where in fact they do now hold around 1.2 million worth of shares. In fact, at the current valuation today, around the $27 mark, this equates to a $32 million investment. Now, the company itself is down around 3% year to date. In fact, just over the last month, it's down 41%. So a company that is down quite a significant amount over the last 30 days, whilst also trading in the mid to low end of the 52-week range, and one where we have a strong buy from Wall Street and a double buy from Seeking Alpha and Quant, could perhaps be a good investment for us to consider and follow along with Nvidia at this massive drop that we've seen. So we're going to uncover that today, whilst also considering the fact that Nvidia do hold a significant amount of cash on their balance sheet, one that only increases over time, right now going from 5 billion in 2016 to now sitting at 43 billion. So we do anticipate they are very careful with where they put their money, and one area that actually highlights this is when we do look at their own ROIC. This typically shows us how good management are at effectively allocating their capital, and right now in 2025 alone, that capital allocation does sit at 90%, so we do have some faith that Nvidia do know what they're doing when they are spending their money. And today then the focus is on Nebius. Now, if this is a new company to you, it is effectively a cloud platform. They provide AI infrastructure, computing power and storage solutions for businesses and developers, whilst also offering high performance GPUs, AI model training, scalable cloud services similar to AWS or Google Cloud, and they focus on accelerating AI and machine learning workloads with optimized hardware and software. They also provide data security, managed Kubernetes and enterprise cloud solutions, and their services are ultimately designed for startups, enterprises, and researchers looking for efficient cloud computing resources. Now, in addition to their core AI-centric cloud platform, Nebius Group operates 3 other businesses under their distinct brands. As you can see, we have Toloka. Now, they're the data partner supporting all stages of the AI development, from training to evaluation, while specializing in providing high-quality trained data for generative AI, focusing on fine-tuning, alignment, and evaluation stages which require extensive human annotated data. Then we have 1010, the educational technology platform, offers reskilling and upskilling programs for individuals pursuing careers in technology, providing affordable, high-quality training through a blend of bootcamp and massive open online courses with in-house developed course content. And then you can also see Avride, the developer of autonomous vehicles and delivery robots catering to sectors like ride-hailing, logistics, e-commerce, and food and grocery delivery, with their applications including passenger rides, hub-to-warehouse deliveries, and package deliveries to end customers. And ultimately, these diversified ventures complement the Nebius Group's mission to provide comprehensive AI infrastructure and services across their various industries. And as we can see, at the very basic level, they are an AI-centric cloud platform building large, cost-efficient GPU clusters, and one reason why this could be a very good time to consider the company, because right now we are seeing some massive growth across the artificial intelligence worldwide, and they also have, no surprise here, a long-standing collaboration with Nvidia. Now, they also believe that growth in generative AI is going to continue for the longer term. In fact, to 2030, they see at minimum a 35% growth year on year in terms of the total addressable market, and the majority of spending on these AI servers are going to move away from training from 66% to 36%, with the real focus here being inference going from around a 34%, 64% user spending. Now, they've got a slide in one of their latest investor presentations covering some of their competitive advantages. The first one that they like to note is AI optimized cloud infrastructure. Unlike other general cloud providers, Nebius focuses heavily on AI workloads. They're offering high performance GPUs and optimized computing for machine learning, making it an attractive alternative to AWS or Google Cloud for AI driven companies. There's also the end-to-end AI ecosystem, which in fact spans from AI data to Toloka, cloud computing, the Nebius Cloud, and their applied AI applications like Avride for autonomous systems, providing a comprehensive stack that competitors typically do not offer under one umbrella. And some other points here like cost-effective and scalable solutions, education and workforce development under the 1010, and specialization in AI data and autonomy. And they also have highlighted here they do have a strong team with relevant experience in the AI industry. They've also experienced some massive growth, which we will come onto shortly. In fact, from 2023 at the last quarter, around 8 to 9 times year on year. And they've also expanded their client base, which sat around 10 clients at the end of 2023 to now sitting at over 40, one that they only anticipate will grow at a much faster rate, and also driven by their capacity expansion, around 2,000 at the end of 2023 to around more than 20,000 GPUs expected by the end of last year. And one key highlight which we will touch upon here is that they believe they will become adjusted EBITDA positive in 2025, something we didn't get to see in 2024, with a significant spending somewhere in the 600 to 1.5 billion mark on capital expenditures, where the large bulk of this will be on the Nvidia GPUs. Now, if we look at their earnings for 2025, they do expect EPS to be negative until Q4 2025, where they anticipate this to turn positive, and hopefully this will only continue to grow, as we're seeing even the negative element here is getting smaller and smaller with time, and this is something that is very important for us when we are considering this company. Do we believe for a company that is at the moment losing a fair amount of cash, they can turn positive on quite a number of metrics? Now, their latest Q4 earnings came out last month, where the group's revenue sat at around 38 million. That was a 466% growth from the same quarter last year. Now, they do say this was ultimately driven by their core AI infrastructure, which grew around 602% year on year. However, they did still report an adjusted EBITDA loss. Remember, 2025 for the full year, they are expecting this to be positive. And looking at the full year of FY24, we can in fact see 118 million on their top line. For the full year, that is a 462% increase. Now, if we look at that in a tabular format, we can in fact see on the most recent quarter, revenues up 466% as noted. However, they are still reporting a loss, one that only got a little bit smaller from the same quarter last year, and the same is to be said when we look at the full year. Again, 462% growth, but we are still seeing a company that is losing money, and even on an adjusted basis, their bottom line pretty much the same for the quarter-quarter comparison, and a little bit, although only marginally better when we do look at it on a full year perspective. Now, typically we like to look at gradings of companies. They do get a B, although bear in mind we're not going to get a valuation on the forward P or even on a trailing 12 month, as their EPS is negative. That if you look at an EV to sales, both accounts, they're trading at quite a significant premium to the overall market on a forward basis at 146%, and the same to be said on a price to sales comparison. The only one here where they do look very good in comparison is the price to book, where it's 1.86, the market sitting at 3.18, and a price to cash flow where they get the A rating at 7.7, again, market sitting at 17.61. Now, we will run it through our own valuation process as well using the DCF model, but we do also want to highlight they are growing their cash flows at a very strong rate, 316%, comparing to the sector that sits around 15. Their cash flows also 69%, well above the sector at 14, and they also generated a positive amount of cash, 787 million just over the trailing 12 months, which is above the sector at 106 million, and also better than what we have seen over the last 5 years, where this has sat at 528 million. Now, we also like to take a very quick health check of the company. Now, we did take a look at Nvidia, but more importantly Nebius, in terms of their cash versus their total debt. Their cash has been fairly inconsistent over the period, although increasing from 588 million in 2015 to now sitting at 2.5 billion. And what we always like to do, because one number here in complete isolation won't tell us anything, is compare it to their total debt, both numerically and directionally. And what we can in fact see, not something we note that often, but whilst their total debt has been increasing, in 2024 it did drop quite significantly. So in fact, it's gone from 381 million in 2015, now sitting at 38 million, meaning they have a far superior cash balance than their total debt. So the balance sheet for a company at the moment that is reporting a loss after a loss does look to be healthy, but again, something we do need to note on a very consistent basis. We'll also just point out that institutional ownership sits around 22%, with only one institutional buyer over the last year, and we can see that was around 9.5 million. In fact, we noticed Centurus Financial on the 12th of March, they added around 343,000 shares, although it is a very small percentage of their own portfolio at 0.6%, and a very small ownership in the overall company at 0.146. Now, before we jump into the the valuation, just to let you know, we have released our latest free weekly article. We draw on every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move into our intrinsic value, which gets to $39 today, derived from the DCF model. Now we have the free cash flow year on year, which has been largely negative. However, they are anticipating this to turn positive in 2025. Now moving forwards, we've gone for a growth rate of 20%, although bear in mind, as always, numbers here are subjective. Low at 15%, 20% for the medium, and 25% for high. Based on 20% though, and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. As you can see, just under $40, indicating 44% upside. Now, full transparency, for those that believe that is way too high at the 15% point, $32 in turn giving 19% upside, and for those that believe it should be a lot higher at 25%, intrinsically $49, indicating 81% upside. As always though, we do like to take through the medium rate, which today comes to 20%, where we do on top of that apply a margin of safety. We use 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today will buy at $35, then we keep going till it's near the current trading price, and what we're seeing for this company right now is around a 30% MOS. Wall Street themselves, with their strong buy rating, love this company. They see this at $60 over the next year, translating to 122% upside. Now what we can also do is show you at the lower rate today, for those that believe maybe 15% is a lot more reasonable, what the margin of safety this would be. And at 10%, you're still getting an MOS. At 20%, not quite there yet. So if you do believe the lower rate is more applicable, which does sit at the 15%, then you are effectively getting a 15% MOS too, with, as we said, Wall Street very bullish, $60 over the next year. That is more than a double from the current value. As always though, give us your thoughts in the comments below. Is this one you're looking to buy? Maybe you've already started to buy, or you don't believe even fits in your overall portfolio. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon as well, where we do cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.